welcome to this week's halftime talk, where we take a moment at the middle of every trading week to look at the bigger trends that might be impacting global energy markets. And we're honored, of course, this week to be joined by Sir Mark Moody-Stuart, well known to everybody as the former chairman and managing director of Royal Dutch Shell, chairman of Anglo American, and I think perhaps even the longest serving board member of Saudi Aramco, the world's biggest oil producing company. Sir Mark, welcome to the show, and thank you for taking the time.
Thank you very much. It's a pleasure to be here. Thank you.
I understand on this occasion you're speaking totally in your personal capacity and none of your associated hats and corporate engagements. I'd like to start, Mark, with slightly bigger picture. Clearly, the world is going through a cataclysmic moment. The industry is going through its share of that big change. What's your own sense about what it means for the oil industry from which you spent most of your career? Is this a defining change moment? Shell, your former employer, did pull back on its dividends for the first time since you were 5 years old. And so what do you think about the bigger picture of what's happening at the moment?
Well, I think it's a tipping point in the industry for a variety of reasons. If you look at the oil is an unusual commodity. It's the only commodity where the lowest cost producers for 45 years have restrained production and allowed higher cost production to grow. And that's been going on since the 70s. It started with the expansion of the North Sea. We were saved by OPEC putting the prices up, otherwise it would have been a disaster. North Sea, North Slope, then later deeper water production, and then finally now oil sands and of course shale. And that system has worked basically, provided demand was growing. And demand has grown, not hugely, but consistently over the past decades.
We went into this crisis at 100 million barrels, more or less, of demand.
Exactly. Clearly at the moment, a point is approaching where, never mind coronavirus, there would probably have been a flattening of demand. I personally thought it would come in the mid-20s, and clearly 2023, 4, 5, something like that. And you could see, now once the flattening occurs, then the situation really changes. Whereas the low-cost producers would have been happy previously, maybe they lost market share, but because their production could grow a little bit and prices were up, they were happy. If you come to a point where demand is flat, then the game changes. They cannot continue to restrain production to keep the price up, because otherwise it would wither away to nothing, basically, and the high-cost producers would take over. So I think this is a point where the emergence of oil as a normal commodity, where low-cost producers dominate in market share, and the higher cost producers fill in the tail end, which is what happens in iron ore, nickel, copper, all normal commodities. I think that's coming, and coronavirus has simply very dramatically accelerated that. Of course, the fact that...
Can I just interrupt you, Sir Mark? In the last two occasions that OPEC and the major oil producers, Saudi Arabia leading OPEC, tried the market share approach, 2015, 16, and most recently in March, they seemed to retreat from it very quickly, and everybody got burned badly. They don't seem to have a sustainable appetite for it.
Well, I think this time is different. I mean, I think they're in it for the long run, for the end of this year at least. Now, predicting oil prices and behavior of producers is always a mug's game. And there are many unpredictable actors in the scene, not least President Trump. But I think it is different this time because there is this existential threat, as it were. It's you cannot in a flat and I'm not suggesting, I personally don't think the market will decline very much, but it will be flat, maybe decline a little. And
you're talking about demand.
Yes, demand. I think in a flat demand situation or slightly declining, but even flat, you cannot keep cutting production to hold the price up and let everyone expand into the space. So the high cost producers have to realize that the game has changed. And I think it will take the rest of the year to get them to really take that situation on board. So I think
that includes the banks, I would say, the banks.
Absolutely.
How would you interpret the recent standoff between Saudi Arabia and Russia? And if indeed it was or not a standoff between Saudi Arabia and Russia, what's your view on it? And did they stumble upon it, or was it a long thought strategy? How do you interpret it now that it seems to be resolved?
Well, I think it was a question of maybe the Russians came to the conclusion that you can't keep cutting. And then there was the argument as to who cuts what, and that will continue. There is only one rationale for an equitable way of distributing production, and that's cost of production. The low-cost producers should have the biggest market share. And I believe that it's well possible that when the high-cost production has been seriously squeezed, which it is at the moment, say by the end of the year, that by that point, I mean, there is, of course, a huge overhang of supply at the moment, 20, 25 million barrels a day. So no amount of cut is going to fix that. But the damage that will, it will reduce higher cost production because they will have to cut. And I think there is a possibility that, say, by the end of the year, next year sometime, things could be, maybe it'll take a couple of years before supply and demand come more or less into balance. And I think we will come out of it with the lower cost producers, including Saudi Arabia, having upped their market share. And
if you look at the driver of this over the last decade, coming out of the 2008-9 crisis, the stimulus quantitative easing that pumped liquidity into the markets, a lot of it ended up at the doorstep of high cost oil producers, whether it be mom and pop in Oklahoma or wherever. We're seeing another huge pump in of liquidity and stimulus. We could see the same thing happen again, even though the price point doesn't make sense. Would you have concerns around that?
Yes, and I think the price, I mean, when supply and demand come back into balance, my belief is that we would probably fetch up with prices a little bit, maybe a bit above 50. And normally people would say, yeah, but the low-cost Gulf producers, Saudi Arabia in particular, they need more than that. Well, there's another way of getting it. You pump more, so you do an extra couple of million barrels a day at $50, it's more or less the same as $70. And if you go back immediately to high costs, high prices, 80, 90, the high cost producers will begin to stir again. They won't, many of them will be dead, so they won't have much room for energy for stirring, but they will pick up. So I think if the situation is to be managed, we will probably need ongoing a somewhat lower oil price.
What does that mean for for the international oil companies, the IOCs, Exxon and Shell and BP and all the big players that you spent much of your life with?
Well, most of them can, I think you would be a foolish major if your project screening assumption on price was any dollar above 30, say, and probably slightly less than that. And there are things that you can do at that. Big projects, long-term projects, which can be done. In the short term, many of these have been deferred, and that will be part of the rebalancing because there's been a serious deferral of projects, which in normal times would be reasonably economic. So, and that's the concern that people have, is that production growth, replacement of declining production will have stalled, and then we will suddenly have a crunch and be short of oil.
I'm not sure if you're still a shareholder of Royal Dutch Shell, but what did you think of the decision last week for dividends to be cut for the first time since the Second World War? And interestingly, Shell being the outlier rather than the trend, in sense that most other majors didn't follow suit. What would you have done if you were still running Shell?
Well, I can tell you, I am still a shareholder, and the shares are basically in the hands of my children. It's not a huge amount of money, and they get every half year a small income from it. And some time ago, one of my sons who used to work for Schlumberger, I talked to all of them and I said, okay, here's the game. Shall we switch out of those shares, which we all know and love, and where would we put the money? Where would we find something if we get 100 out? Where are we going to put 100 in order to get a decent return or a return? And the answer was nowhere. So they all said, nah, Dad, let's leave it there. Yeah? So now I ring them up and tell them, yeah, that's what happens if you go for high yield. But yeah, would I? Personally, I think it's prudent. Whether I think it's a useful signal. Now, whether they overdid it, 2/3 is a big whack. Whether that's really kitchen sink stuff. But I think it will be followed by others. And
do you think others will follow Shell, that it's inevitable?
I do, yes. I also think the really interesting thing is, will that enable one or more of the energy majors to really begin to switch into low carbon, hydrogen, carbon capture and storage, renewables, and so on. And I've written about the fact that we've always said, the challenge has always been, we said, listen, there's nothing like a good oil field to give you a decent return. In renewables, it's profitable, but on a discounted cash flow basis, it always looks pretty miserable. The analogy I've drawn is with liquefied natural gas. I mean, in the 90s, early 2000s, and going back way beyond that, every liquefied, in the 80s, liquefied natural gas scheme that we came up with, we struggled to get the conventional DCF return above, into double digits, compared with much higher returns on upstream oil. But after a while, when you have a series of these things, and they're different investments, high upfront capital and very low ongoing capital expenditure. So your grandchildren bless you because you have this constant cash flow. And if you build a portfolio of 10, 12% returns with this upfront investment, after a while, you have a very strong cash flow.
And how do you think investors are going to look at this change? Shell being the bellwether, perhaps for others to follow. How will it change the perception of the industry, and how should the industry adapt or change for that?
Well, I think it requires a degree of understanding between long-term investors. If you look at the long-term investors, the big pension funds and so on, they've been saying to the majors, listen, we want you, they've had an internal argument with themselves, as it were. We want you, speaking to the oil companies, we want you to demonstrate that you're really into this transition, that you're going ahead with it. But on the other hand, they were highly dependent on the dividend. And again, something had to give, I think. And now it's begun to give. Whether Shell overdid it or not, I don't know. But it's certainly an important signal, I think. And I think they will get some support from the long-term investors. But that support will be conditional on what they do with it. I mean, what do they do with the cash flow?
Well, it's like you said, it shows prudence. Perhaps it will secure their ability to still raise capital on the debt markets.
Yeah, no, I think that's true. I think it is going to be very interesting how it turns out, and who follows, how much they follow. As I say, my gut feeling from the outside as an interested shareholder, who of course would like them from a purely personal point of view not to have cut the dividend, but I think it was a wise move.
Well,
whether it was too much or not remains to be seen.
As you say, it was a bit of a whack.
It was a whack.
If we segue from that to Saudi Arabia in terms of demonstrating prudence or responsible account managing, we've seen over the weekend the kingdom announce some pretty serious austerity measures in terms of government balance sheet, and today headlines 40% salary cuts with private sector, but including nationals. How do you assess the challenge currently facing Saudi Arabia?
Well, that's, for decades, that's always been the challenge in Saudi Arabia. And I think it's an important step in trying to wean the population off a sort of entitlement feeling and say, listen, times are tough. If we want to go ahead and we want to make sure that Saudi Arabia has as the lowest cost and largest producer, has a long-term position in oil, this is probably what we have to do, and we're going to probably have to do it for the rest of the year at least, and that means everybody joining in. So, but we know that the government is always sensitive to popular opinion and what the street is thinking.
Well, last time oil prices were this low in the 1990s, it was during your reign, and there was some serious socioeconomic fallout in the kingdom.
No, I remember. And I remember when, oil was at very low, I mean, down to nearly $10. We at Shell were we were doing quite a lot of stuff on social responsibility and so on. And I was very concerned that if we got ourselves into financial trouble, people would blame it incorrectly on efforts on the social side. So it is a big challenge, and I'm not in government, but I think it is important. But it needs to be across the board. I mean, in the UK, government is always saying we're all in it together, and that's viewed quite cynically by some members of the population.
Yes. Well, if you take your other hat or one of your other engagements, Shell obviously did the big whack. How will Aramco, Saudi Aramco, with their first dividends, they made a very big commitment before they went public. Do you expect them to stay with that dividend commitment?
I would imagine so, yes. Yeah, I think so. I mean, you know, when a company looks at its forecasts, it looks ahead for a year. You know, now what's going to happen to oil prices next year is anyone's guess, but I think certainly for this year, fine.
And finally, Sir Mark, one of the big global trends that are emerging to impact every market, and it is not new, but it seems to be getting harder. We had the US-China trade war. Now we have the US versus China blame game on COVID, and it seems to become the boiler issue for the US presidential election. How do you see the growing tensions between the US and China, and how should major global CEOs, major energy company leaders, do you think, navigate that?
I think the role of business is, I mean, I think that it's a very faulty approach to China. I don't think now is the time to start throwing bricks and criticizing, because, you know, it works in all directions. I think the role of business is to stay calm and try, and I've always spoken about the fact that business across fractured political borders, if we can maintain solid, commercial, mutually beneficial contacts and contracts, then we have a kind of people to people, business people to business people, realizing that the other side is not a bunch of devils. And I think that goes much, personally, I think we should have maintained commercial relationships with Iran and so on. I believe, I'm not a believer in sanctions. I believe that, in fact, one of the great blessings was in the original, you know, when Nixon went to China with Kissinger and so on, they could then have said, you know, this is an awful regime and we're not going to have anything to do with it. But bless them, they actually had the wisdom to say, no, we need to talk to them and let's, you know, play a bit of table tennis and so on and get going. I've always said that that's one of the strokes of good fortune, that they took a mutual approach rather than an isolationist approach. It would be a huge tragedy if that now changed.
Do you think that that is a likely? Could we end up in a Cold War sort of you're choosing side situation?
Well, I would hope that business, and the president does sometimes listen to business, would persuade him that this was not entirely not a good idea. And he, you know, he blows hot and cold. Sometimes he's on, and you never tell what he's going to say next tweet.
Yeah, I suppose with the election coming up.
Yeah, exactly. The election doesn't help. He would like to postpone it, I'm sure.
Yeah, well, everybody with that sort of authoritarian bent doesn't like elections too much. Just finally, as a wrap up, Sir Mark, we're certainly in a period in which we have endless black swans and all sorts of colors of swans. Is there anything that we're not seeing, the unknown, or anything that you're looking at that is a particular, that you would raise a little flag that people should watch out for on the energy markets and the energy world?
No, I think we need in the energy transition, which has to come, we need a more coordinated approach. Some people have said, is this reduction of oil price, upping production, is it part of a plot to try and kill off renewable energy? I don't believe that. It was a plot to try and reduce the increase in production in high cost producers, but I never heard any discussion of the impact that it would have on renewables. But what we do need to do in alternative energy is not get completely committed to electric everything. Because for heavy transport, for shipping, for aviation, electrification, battery storage, which is extremely important, uses materials which come from difficult parts of the world. And we need to be careful that everyone, having vilified the oil industry, doesn't now get themselves into technologies which also have strong resource demands and resource demands from difficult places. So I think the oil and gas industry should use its technology, looking seriously at hydrogen. I've been for 20 years a huge believer in hydrogen, and hydrogen is now also green hydrogen, or at least blue hydrogen, but green hydrogen from renewable energy is becoming important, and that would allow an alternative storage and transportation method, which could be sourced in green ways, but with a transition using the hydrocarbon industry. So that's where I would be careful of.
Would you advise the IOCs, your former peer group, not to see this moment as an opportunity to get out of the energy transition commitment, or is it an accelerating moment, or is it an exit moment from that commitment?
I think they would be extremely foolish to think of exiting from their commitments. Those of them that have made commitments, of course, not all of them have, and that's a bit of a transatlantic divide. No, I think the European majors will definitely hang in there, but they need to hang in there looking at where their skills are, and if they're going to survive for another 50, 100 years, the business has to transform itself. And history shows that companies have not always been successful in that. I have great faith in them. I think there are a lot of brains there. I have a lot of good friends doing it, and I think it's an exciting time.
Well,
too exciting.
Let's hope I think the wisdom for the whole industry, I would suggest, is they need to do everything a little bit faster than maybe that had been done in the past.
And I think that may require some bolder bets. And I think the stresses we have at the moment, and things like Shell's cut of the dividend, may encourage them to do bolder bets. And if you do bolder bets, the risk goes up, but the reward, you might land up being the leader in the end.
Well, the reward might be survival as compared to the opposite.
Absolutely, absolutely. No, I think it might be, and the tendency has been sometimes to say, yes, we're going, but we need to do it very slowly and carefully. We've got time, we're still going to be producing oil in 2050, which I think is probably true. But I think many of them are coming round to the view that demand will peak at 100 million or just over 100 million.
Well, if you look at the demographic numbers out of the developed economies over the next decade, particularly leading with Japan, 10 to or 8 to 12% decline in the the working population is a huge amount of demand erosion, regardless of COVID. Everybody has to pay a bit of attention to that.
No,
I think we have to wrap. We have to wrap the call, wrap the conversation. Absolutely wonderful as always, Sir Mark Moody-Stuart. Thank you so much for being on Halftime Talk this week at such a critical time in the global energy transition and the change of the world economy, and of course the energy industry smack in the middle of that. We'll see how it plays out. But again, thank you so much. And we look forward to catching up in person again.
Much. And since it's all recorded, you'll be able to listen next year and see what we all got wrong.
Exactly.